Hello, everyone, and welcome. My name is Philip Palumbo. I'm the host of the Palumbo Podcast, where we interview some of the most successful founders of companies to learn how they got to the top. Today, we have with us Kevin Donnelly, who's an investor, CEO, coach, and value growth advisor. Kevin founded Speedwire, which was the largest security and smart home installation subcontractors with over 600 technicians nationally. He eventually successfully exited to a publicly traded company and went on to launch a similar technology field services company that he then exited successfully again just a few years ago to private equity. Since then, Kevin has taken his experience as an entrepreneur to help founders both scale and increase the value of their business while reducing its reliance on them. His process begins with a baseline assessment that helps them develop a value creation blueprint designed to maximize the value of the business. So Kevin Donnelly, thank you so much for being on today. I appreciate it very much.
Great. Happy to be here. How you doing, Phil?
Doing great. Thanks for asking.
Right.
So Kevin, we know each other for a long time. You've had tremendous success, both exiting not once, but twice. And that's a lot of what I talk about and a lot what I'm trying to help founders of business on as well alongside you. So I want to start first with my audience understanding. How did you start your business that was was the largest at the time nationally?
Yeah. So took me nearly 20 years to become an overnight success. I grew up in a family of Wall Street types, and I was a finance major in college. And then I graduated in the original Great Recession of 91 and ended up getting a job on Wall Street at Morgan Stanley. Not in the finance piece, but in the technology services area. So I spent 2 years on the trading floor, moving around the traders, doing market data and phones and computers, and then I spent a couple of years in the what they call the wide area network space, where they had the connectivity connecting the offices domestically and globally, and so it was at the time probably one of the most state of the art networks. And then I became a network manager and was working 3 days on, 3 days off. And so I got approached to start doing installations as a side hustle. And it was my first exposure to small business, and ended up leaving Morgan Stanley to run installation services for a data communications equipment VAR. And that was like right in 95, 96. Netscape went public. Really, it was at the dawn of really broadband. And so I ended up leaving and starting my first business, Speedwire, in 97. And, what happened was the Telecom Act of 96 created all these small telecom companies. So, things like DSL weren't from AT&T until years later. And so all these small companies did not have their own technicians. So I basically started doing installation work as a subcontractor. And, next thing you know, 97, 98, 99, I went from, a handful of people to, very quickly, about 2000, I had about 40 technicians working for me. And we probably installed the first, broadband in homes in America. And then had a series of kind of on the ground floor of a lot of interesting things of, video conferencing and Wi-Fi. I mean, we installed Wi-Fi on at scale for Verizon. I ended up becoming Verizon's kind of apartment building broadband contractor in New York City, even before there was FiOS. And so I kind of started working for the small businesses, and then ultimately worked my way up to working with Verizon, and then ultimately AT&T. And so I had kind of a straight up run for a while, and then about halfway through ended up working with Verizon on their FiOS project, and kind of overextended myself without really having the work coming in the way that it was promised, and ended up about halfway through my journey, about 10 years in, ended up having a layoff. I laid off half the company the day after Christmas 2006. Wow. And then shortly after that, I got into EO, the Entrepreneurs Organization, which I know you're a member of, and really started becoming a student of entrepreneurship and studying, a lot of the great authors, Vern Harnish, the founder of EO, and the Rockefeller Habits, and Michael Gerber and the E-Myth, and really all the great thought leaders in entrepreneurship. and really, realize that there's this journey that I was on of starting out as a technician and then becoming a salesperson, that really there's a third leg to that, which is becoming the business guy. And so for a long time, the business just made money. But then as you start getting into, 80 people and much bigger payroll, sometimes there's not a lot of room for error. And so, the things that I teach nowadays to my clients around the importance of monthly financials and the need for having a business operating system and things like focusing on, value just over just simply profits, are all things that I had to learn the hard way myself. So my goal is to shorten the learning curve for the folks that I work with.
That's excellent, Kevin. So when you think back prior to exiting your business, because that's a big question on a lot of people's mind. I mean, most of the business owners today are baby boomers, right? That's really where most of the wealth is, a lot of the transfer wealth we're going to see. And a lot of them are saying to themselves, am I really ready to exit? Not just from a financial standpoint, but more even from a psychological standpoint. When you exited your first company, how old were you?
44.
So 44. And you exited at a really nice number. And at that time, you were unsure what you were going to do, et cetera. But just walk me through at 44, at what point did you decide, hey, I'm ready to exit this business?
What was interesting, it was an unsolicited offer. A competitor approached us to acquire us, and I ended up hiring an investment banker and running a quickie process just to make sure I wasn't leaving money on the table. And ultimately, the initial offer was the offer that I accepted. And what had happened was AT&T became a huge piece of our business. So I had a massive customer concentration issue that was going to be hard to get around. So it was interesting. I ended up having two offers. I had an offer from a competitor, known as a strategic, and also from a private equity firm. And the private equity firm offer was actually better. But I realized that from a lifestyle standpoint and from a pressure standpoint, just taking the strategics deal was a better choice from a lifestyle standpoint. And so I know that Phil, you also became a certified exit planner, and there's a lot of really interesting fundamentals. And I kind of talk a lot about the parallels in Simon Sinek's book, Start With Why. And, he talks about, if you start with why, then you can move on to the how and the what. And the parallel here for a business owner is, if you start with why, what to me that means is really getting clear on why you want to exit your business and what you want to do next. And the idea is to be building a vision for a compelling future that you're drawn to, versus being pushed out from a suboptimal kind of situation where maybe the business isn't going so great. So the idea is, be intentional, be clear about what you want to do next, and then you can figure out, okay, well, then how can my business support my life goals? So that's where you start looking at, all right, am I willing to, do I need, am I just want to be done with this and sell the business and move on to the next thing? Or am I willing to, roll some chips over, as is really common with private equity, and stay on board for the next couple of years and try and get that second bite of the apple? Being clear, is that really what you want, is super important in terms of having a, what I call an epic exit. And exiting epically means that you sold for maximum value, right? You haven't left any money on the table, that it's on your own terms, that you're either working or not working based on what you want to be doing. And that at the end of the day, you have no regrets, because as you know, the statistics are pretty scary. That first of all, only 1 out of 5 businesses that go up for sale end up selling, and of those that sell, they say the statistic is 4 out of 5 sellers end up with regrets afterwards. So that leaves 1 in 100, really having an epic exit. So I think really asking a lot of questions and getting curious and being thoughtful about what you want to do next, how the business can help support that, and then you can figure out what you need to do to make it happen.
Everything that you and I have learned as CEPA's certified exit planning advisors, right? Where it's the personal side of things, we call it, personal. It's like you 2.0. What does that look like? And then there's the financial aspect of it and blending it all together. And then there's maximum value and understanding really what that means. So from your first exit and what you know now about exiting, if you would have known what you know now, would things have been different?
For me, at the end, I landed a huge deal with AT&T, and they were just an amazing customer, and it was really an incredible, for me, it was like my own personal version of the Super Bowl. The downside of that was that the customer concentration that came along with it, they became 90+% of our revenue, and so it would be awfully hard to diversify a situation like that. So it kind of is what it is, and so I maybe could have held out longer and made some changes and gotten an increased multiple. But for me, I think the best opportunity was sometimes that you just have to look at the situation and, just do the best you can. And my decision was it makes sense to exit. And then I worked for the acquiring company for a few years, which was really interesting to be a vice president of a public company. That was a whole nother experience that was really valuable to me. And then and now, just a lot of these experiences and lessons and studying really, come in handy when I'm able to, it's like every time I work with an entrepreneur and they come to me with a scenario, it's like I feel like, oh, I've seen this movie 3 times. I've witnessed a lot.
Yeah, no, and you have, so Kevin, you worked with me in my company, and when you started until the end of when we worked together, it was invaluable, and a lot of it was because of the experiences that you had and things that I've always thought of. But when you have the accountability person next to you, really pushing at you to get things done, it really was tremendous. So I want to transition now to your U 2.0, right? So you as a CEO coach, a value coach, a value growth coach. So just walk me through, you sit down with a business owner. What is the first thing you do? So if I say, hey, Kevin, I have this business owner, they don't necessarily need to be selling today. They may be selling in 3 years, or maybe they want to sell today or in 3 or 5 years, whatever it may be. What are the first steps you go through with that business owner?
Yeah, well, if it's a business owner like you talked about, a baby boomer who's thinking about exiting, in the exit planning world, we talk about the 3 legs of the stool, right? The business, the personal, and the financial. And so I'm a member of a community called the Value Builder, which is founded by a guy named John Warrillow, who wrote a book called Built to Sell, and they give us some great content. And but there's the real driver is these 3 key assessments. And so we have one assessment called the pre-score. PRE stands for personal readiness to exit. So we kind of talk about, do you know what you're going to do next? So things, the complicated issues around your identity. Is it, Palumbo plumbing, and you're a 3rd generation plumber, when you're 50 years old and all of a sudden, you and your father and your grandfather are all Palumbo plumbers, then, there's a loss of identity there that needs to be recognized and kind of dealt with. And then the second score is what we call the freedom score. So that's really gives you, takes what your anticipated lifestyle needs are moving forward and turns that into a number. And what we come up with what we call the wealth gap. So, all right, in order to fund my lifestyle after, broker fees and taxes, what do I really need to sell the business for? And then the third score is the Value Builder score. And what that does is really look at an estimate of value of what your business is worth, along with what a best-in-class company in your industry, what your business could be worth if you were considered best-in-class. So what we're doing is scoring the business on the elements. If you think about what private equity, which is kind of sort of, I don't want to say the gold standard, but you get the drift there. It's what does private equity deem valuable? And so they're looking for businesses that are growing, businesses that have strong margin, businesses that have a great story about how this thing can continue to grow, businesses that have strong recurring revenues, that don't have not only customer concentration, but also they're aren't overly reliant on any particular employee or any particular vendor. And then a big one is being that the business is not overly dependent on the owner, because that's a big factor, is that in order for a business to have maximum value, it can't have to require the owner to be involved in everything. So that's a lot of the work that I do is around getting the business owner. What I talk about is teaching them to transition from being the lead singer and guitarist of the rock and roll band to being the
Yeah.
conductor of an orchestra.
Yeah.
And
So, yep. So that to me was I thought was very, very valuable, right? Because as you know, a lot of business owners, they're in the weeds of their business. They're not delegating anything, and they're not getting anywhere, and they're not at maximum value. So for me, like the umbrella is best in class. So how do we get you to best in class? Not only just from a valuation perspective, which obviously is important, but even more so, how do we build your business so it's best in class, where everything that you're doing, you're delegating, and you're the CEO that's managing the overall business and the visionary to really get your business to a level that you probably maybe even dreamed of. And you can't do that unless you delegate. So just as we talked about, as you coached me, just talk to my audience about the idea of delegating and getting you out of the weeds and the process that you go through with them to do that.
well, it all starts with, everyone's heard the quote from Jim Collins and Good to Great. You got to get the right people on the bus, the wrong ones off the bus, and then you can get everybody in the right seat. And
That's right.
that's really an important part is like you need the people to delegate to, right? So that's like kind of the asterisk. And so it's really about getting good at hiring. And that's the number one thing that I run into when I go into companies is everybody sucks at hiring. And so that's where I teach, things like how to implement an applicant tracking system to get, you're not going to be successful if you're not organized. And then how to conduct interviews. And I give interview guides. I teach, leadership teams how to do interviews. We have assessments that we can introduce you to really, and the goal is you just got to get A players on the team, and you got to spend the time and you got to spend the energy to get the right people on the team. And then even more importantly is that when you get that hiring muscle and you feel confident in your ability to get great people on your team, the people that are not showing up, the empty suits and the people that are toxic, you've got to move quick and get them off the bus, because there's just, the more you let that fester, the more problematic it is. So and I think you run into all different scenarios where the entrepreneur, the founder is loyal because somebody's been on the team a long time, but you've outgrown them, or they don't, they avoid conflict and they just don't want to be they're afraid to fire the person, and they're afraid the whole thing's going to fall apart. But again, that also goes to you can't be overly reliant on any employee. So that's that's one of the areas we work on, is helping to look at implementing procedures like standard operating procedures, and things like Trainual, video documentation of all the processes, so that if anybody gets hit by a bus, that the business is going to keep on moving.
Right. So hiring the right people. Let's say we got all A players. Right. The other important component is, I call it siloing the business, compartmentalizing the business. In other words, you have in any business, if it's run the right way, you have sales and marketing, you have the financial part, you have, let's say, compliance, you have HR. So one of the things that you had spoke about is that each person is responsible for their particular lane, and they always need to be staying in that lane. And if they need to delegate within that lane, they'll delegate within the lane. So talk about the compartmentalizing of a business.
Yeah, I call it 3 swim lanes. So to your point, it's to me, the main ones are sales, operations, and then typically I lump finance and administration together. And then typically there's a fourth, think of it as a specialty one. So if you're a staffing company, your head of recruiting might be in your key 4 high, direct reports, or for a financial planner, it might be the chief investment officer. So the idea is, I'm a big proponent of a system called Scaling Up. There's which is a business operating system. There's many of them out there. EOS or Traction is another one, or System and Soul or Pinnacle. But they all have the same goal, which is to give the business owner the ability to lead the team without having to be involved in the day-to-day weeds of everything that's going on. And so, it starts with getting competent people on the leadership team. And then the business operating system, sets things like the communications rhythm. So daily huddles and weekly meetings and monthly meetings and quarterly meetings, and there's specific agendas for each of the meetings. And then by the activities that we do in terms of coming up with priorities that are called rocks, and the way that we assign, the idea is to get everybody in the business working smarter, not harder. And in the 7 Habits of Highly Effective People, Stephen Covey talks about quadrant 2, which is, most people spend their time in the business working on things that are important and urgent, which is also known as firefighting. But if we can get everybody to shift some percentage of their time to working on important and not urgent things, that's where the real value is. So we have these quarterly meetings. I had run a couple for you where we kind of get offsite and get everybody looking at, things like the strengths and the opportunities, or the weaknesses, the threats, the challenges, and then we come up with the strategic initiatives we need to work on. And then we get the leadership team to own an initiative for the quarter known as a rock. And that's really where we start making progress. And so the meetings have different purposes. The weekly meeting that the members of the team show up to show the progress they're making on the rocks. And, we have these daily huddles with pulsing the KPIs. And so what we're trying to do is create a culture of accountability, or peer accountability. So it's not like, oh, Phil's going to be mad at me because I didn't get my homework done. It's more that, hey, we have a high performance team here. Like, we're trying to build the New York Yankees. And if you're going to be an empty suit, there's not going to be a place for you. So we get that culture of accountability, culture of execution, great communications. And so that's what a business operating system does. So if you get the right people on the team, you implement a business operating system. And then to me, the third piece is running the business by the numbers. So and that's another big thing we see is that it's a lot of business owners, they kind of have their head in the sand, or they don't have the right person. But by hook or by crook, whether you have to implement a fractional CFO or have your accountant help you with it, by the 15th of every month, you got to have monthly numbers and sit down and take the time to review them and understand them. And by having the right people, the system, running the business by the numbers, and then focus on building a valuable business, that's really, you're going to come across as, when it's time to exit, as a super well-run business, and you're going to command a premium.
So everything you're saying is really the most important part of this podcast, because it's, when as a CEO, when you take yourself out of the weeds and you compartmentalize and you have people and you delegate everything efficiently, you take a step back. When you have time to breathe, you can think more about the business, because I feel like a lot of business owners that are not growing, and when you talk to them, a lot of them are, I hate to say this, too cheap to hire people, which means delegating. And if you can't delegate, you're not going to grow. It's just impossible to grow if you're not delegating and taking that step back. And when you're trying to build a world-class, best-in-class organization, that is a must in doing that. And the part that I think a lot of people struggle with, and I get it because I've been in that camp, and you and I spoke about this too, is, all right, well, do I really need to spend that money? Because maybe I have an hour a day to take care of that. But then you keep saying to yourself, an hour piles on to 2 hours, it piles up to 3 hours. And again, it goes back to being, and then next thing you know, you're in the weeds. You're not really giving your company the ability to do what it has to do. In some respects, you have to have faith in that. And that's really important. So
there's an hourly rate that you can also, people sometimes talk about. It was like, I tell people, if you're the CEO, right, don't be doing $50 an hour work. Don't even be doing $500 an hour work. You need to be doing $5,000 an hour work, whatever that is.
Yeah, that's really great. That's a simple and easy way people to really understand what we're trying to get through to people with this message, which is very powerful. So get the right people on the bus, compartmentalize, delegate, right? Don't be afraid to spend the money. I think that's super important. I just want to talk again, and you mentioned it, is run the business by the numbers. So give me an idea specifically what you mean by that.
Okay. So a lot of times I use this crawl, walk, run reference. And so if crawl, what that means is, as I said, just show me an accurate P&L delivered by the 15th of the month where the numbers are reliable. Like, that's table stakes. The second, once we get to that stage, then we go to the second stage, which is, in QuickBooks, they call it classes, or really it's the ability to have a gross profit by segment. So if, let's say, you're a plumbing contractor, you might have 60% of your revenue being projects, and 40% of your revenue being service calls, you need to understand what is my margin on projects and what is my margin on service calls, and really understand where you're making money. Because there's a lot of businesses that have 5 or 6 different divisions, and we could look at it different ways. It could be a region, is it my Northeast versus my Mid-Atlantic versus my Southeast? What are the margins? You really understand, you got to understand the numbers. And then once you kind of got, that second stage, the third stage where you're really cooking with gas is what I say is very simple, which is implementing a rolling budget, which is, so if you think about a 24 column spreadsheet in January or whenever you start, you put in January projected actual and February projected actual and March and so on, and you have 24 columns for 12 months. Each month has a projected and an actual. And, in the beginning, you take a stab and guess based on your trailing revenue what your budget is. It doesn't have to be perfect. But then when the month closes, you're going to fill in, okay, this is my January actuals. And then you're going to compare them to your projected. And then what you're going to do is you're going to say, I projected insurance to be $1,000, but it was $1,500. Then you're going to go out in the future to all your future projecteds and you're going to change it to $1,500. And after you get 3-4 months of this, what I say is it's like, how can you fly an airplane if you don't know what altitude you're at, how much gas you have in the tank, what speed you're going? It's the same thing with running a business. Like, you really need this. You need to use the financial data as your controls to run the business. And when you want to make a decision and say, all right, do I hire 3 more salespeople because I'm excited about some new product? That decision should be made in the spreadsheet, and you really need to understand the numbers. And so, I find that this takes probably, for somebody that doesn't have, good numbers already, this can be a 2-year process to get from, solid numbers to implementing a rolling budget. But the other part of it is the discipline around once a month, either by yourself, if you don't want to share the numbers, or if you're sharing the numbers with your leadership team, you got to sit down and you got to review and understand what's going on. Because what happens is, I had a client that I was working with. I got called in because they were struggling, and it was February. And I said, you have last year's numbers? He's like, no. So by the time we got the numbers in March, he lost $1.7 million the previous year. And I said, when was the last time you saw financials? He said, a year ago. He goes, I knew it wasn't going good. And he's fighting for his life right now. And he just, he didn't have monthly financials. And so we tend to go on and say it's like, it's not a problem until it's a problem. Like, if you're always making money, it's less urgent. But, you look at what's going on with tariffs, or, like, things change fast. So you just really need to, when all of a sudden things turn around, really understand where you stand, and so you can make decisions. And then you have to manage by the numbers. It's about understanding your model. My gross profit should normally be 30%. My overhead should be 20%, and net 10%. Well, guess what? If all of a sudden every month your overhead is 26%, you need to get the knife out and you need to start making proactive cuts. And that's the other part is people are hesitant. They don't want to do it, but I've just seen so many instances where people get into trouble because they have not been proactively managing the business by the numbers.
Absolutely. It's true. It's not even on the business standpoint, even on the personal side. I mean, obviously, a lot of my clients I focus on are people who sold their business and I have all their money, and then we're trying to manage their lifestyle expenses. And if you're just spending and spending and spending and not really tracking what you're spending, and if you're in budget where we're supposed to be, I don't care if you have $100 million, $1 million, or whatever the number is, because everybody spends relative to what they have. And if you're not tracking it, it could really, you could go off the rails, and it's happening. I've seen some clients already, and I got to keep on top of them, and they don't like it sometimes, but this is what you need to do, because if you fall off the rails, you can't go back and just make up what you just did and build a whole new business and sell it for 50 million or 20 million or 5 million or a million. So keeping track of numbers, I think, is really great advice. And I just want to touch upon the rocks, because to me, I think it's one of the most biggest value add that you and I had spoke about. So the idea and concept behind the rocks is that, so with my team, we meet on a quarterly basis now, and we take a look at, okay, what did we do the past quarter? What do we want to work on the next quarter that's going to move the business forward, right? And then we talk about that and we list them, which we just did. And we came up with like 3 or 4. And then we attached who's going to be responsible for each rock. And then when we meet every week, we go through each rock and how we're doing. And like we did last quarter, which we accomplished every rock, if we continue to accomplish all these rocks every quarter or the next 3 to 4 years, think about how much progress your company is going to have. And that's the idea behind doing what we're talking about doing, rather than being cavalier about everything, as some or many business people are. So, you want to elaborate a little bit on that?
Yeah, no, I think you did a great job of articulating it. It's, I mean, the ideal situation is you're trying to get the leadership team to spend about, in a perfect world, 20% of their time working on initiatives that are strategic, not just, stuck in the day to day, because what you're really doing is solving the problems that are going to be the time sucks in the future. And, I see it all the time that people will refuse to spend 8 hours working on a project that will save them 8 hours a month forever. Right. So you got to work smart, not hard. And these are the things where if
Absolutely.
you're just stuck in the day to day, you never get there. So once a quarter, half day, full day, offsite, talking about the business and talking about what do we really need to be working on to work smarter.
So, for purposes of time, Kevin, the idea is to help the people listening that you want to get your firm company to best in class. That's the ultimate objective, and there are many ways to do that. And we're just touching the surface on how you help people do that. The rocks, the compartmentalizing, taking your head out of the weeds, the business, making sure the business is not dependent on you, and making sure you hopefully don't have concentration risk in just one or two, or maybe, or at least 70% of your business doesn't come from just a select few clients. So those are just some things to think about to get in best in class. Now, assuming you're best in class, you're ready to go. Now, we know, and this is, I think, helpful for everybody to talk about today, is private equity they're all over the place, flush with capital, right? Making offers to everybody, no matter what business that you're in.
Yeah.
So just talk to us about your personal view. If I'm a business owner and I want to exit, do I exit to a strategic buyer? Do I exit to private equity? Do I just exit 30% of my company and look for that bigger exit down the road? So just like you to hear your personal view
Yeah.
about these private equity companies.
Yeah. Well, like I referenced earlier, it starts with, there's a great quote from Michael Gerber that says, the purpose of your business is to serve you, not you to serve your business. So it starts with, what do I want out of life? And where am I in my stage and for people that are, 37 years old, they're different than people that are 63 years old. So everybody's in a different stage in life. And I think you really got to be clear on what you want, because, the ideal scenario is to sell the business over time, right? Engage with a private equity partner, sell a minority or majority, and then partner with them to really grow the business. Because private equity is really a food chain. There's different size firms that we're operating in different markets. So there's, the ones that are looking at those called entry level platform companies with 3 to 5 million of EBITDA to start. And then there's ones that are looking for, more middle market firms doing 50 or 100 million. And then there's the larger players, the Apollo and the Blackstone, right? They're looking to buy the $1 billion businesses. But it really is a food chain. So when you sell to, if you're on the smaller side and you partner with a private equity firm and they come in and you sell half the business to them, and then they give you the capital and they want you to go buy 10 other businesses. I know one guy in my YPO chapter is just sold to private equity. He's acquired like 7 businesses in the last 12 months. It's unbelievable. But what they're doing is trying to bundle that together and sell to like that next tier private equity firm. And the math is unbelievable. When you buy a business for a 5 or a 6 multiple, and then you add on smaller ones for 2 and 3 multiples, and then at the end of the day, you sell the thing for 10 times. The math is ridiculous. And but there's a lot of hard work, and there's a lot of sweat, and there's a lot of, you went from running your own show and doing whatever you want to all of a sudden having to do incredible board presentations and having, 10 times the responsibility. So is that what you want to sign up for? If you're 37 and you're still, up for the adventure, it's a great learning opportunity. It's a great, just incredible opportunity. But, when you're 63, I don't know. I think you got to think long and hard about, do I just want to sell a majority and then help in the transition. So clarity around your why and what's next is the most important thing. And then from there, you can figure out, okay, what's a structure and how do I want to play this from type of buyer that I'm going to sell to. And then you can tactically figure out, all right, what do I need to do? Game plan. Because in the same way we have those quarterly sprints to build that, best in class business. When it comes time to sell, you still kind of have rocks, but they're just targeted a little different. You still want to start doing that work to make sure that you're maximizing the value of the business. That's what a big part of exit planning is all about.
Do you think people can get more for their money going with a strategic buyer over a private equity firm?
Historically, that was always the story. That's the strategics would pay a premium, but I think there's just so much money right now in the private equity firms chasing so little deals. There's if you have a premium, best in class business, that they are going to be the folks writing the biggest check nowadays for sure. Private equity.
All right, Kevin, this was excellent. Anything else that you want to leave us with that you feel would be helpful?
Well, I mean, I think you referenced I sometimes I do a lot of things, as you know, and one of the things is really helping to grow. It's really at the end of the day, what I'm doing is helping people grow more valuable businesses that aren't overly reliant on them. And the key word is growing the value. And I think that a lot of business owners, they wake up every day and they're worried about revenue and they're worried about profit. But the value of a business, as we know, is there's two pieces of it. It's the profit and the multiple. And so, I think many people know how to, just increase their revenue or maybe increase their margins, but sometimes it's almost faster to increase the multiple. And so this concept of value growth or multiple expansion, private equity calls it implementing a value creation plan. The program that I put together is called the Value Creation Blueprint. Just be aware that, in order to maximize the sellable, the money you're going to walk away with, or, you have to focus on the value of the business, which encompasses both, the profit as well as the multiple. And I think that concept is not broadly understood by most entrepreneurs.
Great. Kevin, this has been awesome. You're always great. Your perspectives are great. I appreciate all you've done for my firm. And then, as always, look forward to seeing you soon.
Yep. Thank you very much.